Hey everybody, welcome to a review for the exam number 5. That covers chapters 10 and 11. What this is not me going through the test and giving you the answers to the test. I can't do that. What this is me going through the chapter and highlighting areas that will likely be on the test. This is something that some students are very good at. They're able to kind of look through the chapter material and say, I bet you they're going to test me on this, and others really struggle with. So if it's valuable to you, use it. If it's not, don't worry about it. Do your own studying if you're able to figure this out in a way that works for you. Anyway, so as I look through chapter 10, this is on liabilities, if you remember. Seems so long ago, even though it was just last chapter. Again, so the first thing you want to do when you look at these chapters is look for these blue words. By the way, if you're using the online book, if you click on them, it will actually bring up the definition of the word. And then the bolded terms. There's always in every test going to be a number of questions that are term related. And so the blue and the bold-faced terms are the ones that you're most likely going to have to define. Secondly, because this is an accounting class, you can always expect for each concept it to want you to know how to make the journal entries that go along with it. So you'll see test questions that will say you have such and such a note payable. Please create the journal entry. It won't say please because they're not that nice, but it'll tell you to create the journal entry for the acquiring of a note payable. So this is something that you can't just have like done once in the homework and feel good about it. You've got to practice it until you feel very comfortable making a journal entry for a note payable. Also making a journal entry for an interest payable, which would be an adjusting entry to accrue interest for a certain number of months. Almost always those questions look something like, it'll give you the terms of a note, the face amount, when it's due, and it'll always be due in the following year, and then it will say at December 31st, what is the adjusting entry, where you have to multiply the face amount times the rate times the time, and the time being the number of months that the note has been accruing interest during that month. So you need to not only be able to do this, but know what it means and understand how it works, be able to do it backward and forward, so to speak. And then probably know the other side of it, which is when the note comes mature, what's the journal entry to retire the note, which is just to debit the note, debit the interest payable, and credit the cash. So that's the first thing you know how to do. Secondly, reading through this chapter, there's information on sales taxes, and they kind of break it down two ways. One way, and this is real life, you have some cash registers, and this is most of the time now, that automatically calculate the sales tax and separate it out on the tax register, or the cash register tape, or on the computerized report that it sends to the accountants. If it does that, it's easy to do the journal entry because you simply record the cash received as your debit, and then your sales revenue as the credit, and the taxes payable as the revenue. However, sometimes you don't know the amount of taxes that were withheld. In other words, that you really just know the total amount of money you have, and you'll need to calculate the amount of it that was taxes. And you'll see right here that it explains it to you. The fact that it explains that so very specifically here, that means you have to understand how to do that, okay? And so, let me read this to you. Sometimes companies do not enter sales taxes separately on the cash register. They determine the amount of sales in such cases, divide total receipts by 100%, to determine the amount of sales in such cases, divide total receipts by 100% plus the sales tax percentage. For example, assume Coley Grocery enters total receipts of $10,600. Because the amount received from the sale is equal to the sales price, 100%, plus 6% of sales, which is for taxes, or 1.06 times the sales total, we can compute the sales as follow. And then it gives us a little thing here that we can look at if we want to. Thus, we can find the sales tax amount of $600 by either subtracting the sales from total receipts or by multiplying the sales tax by the sales tax rate. Just remember this. So let's see. To determine the amount of sales in such cases, divide total receipts by 100 plus the sales tax percentage. So we would take 10,600 divided by 1.06, and that would tell us the amount of sales. And then the difference between the 10,600 and the amount of sales would be the sales taxes. This is something you're going to have to know how to do. Okay, just by the way it's listed out in the book, I can tell you that right now. Okay, the concept of unearned revenues. Remember, unearned revenues is when someone pays you in advance for something. This most often happens with ticket sales and with subscription sales, like a magazine or a newspaper. Happens in my storage business because people will pay me for 6 months or a year in advance for their storage, especially people that are headed out of town and they don't want to have to deal with it. And so what happens is my cash goes up and my unearned revenue goes up as well. Cash is an asset account, so it's debited, and unearned revenue is a liability. It looks like a revenue account, but that's tricky. It's not. It's a liability. It means money I owe back to the customer unless I earn it. Then, usually at the end of each month, sometimes at the end of the year, what we do is we record that unearned revenue as revenue because now we've earned it, right? In my storage, if someone prepaid me for 6 months, well, at the end of 6 months, I will have earned all of that money. So I do that by recording a revenue and recording, debiting the unearned revenue, the liability, and crediting the revenue. So again, when it gives you all these specific journal entries, you should be able to do a journal entry just like these, and not just do it, but understand it, because they're going to throw it at you with a little bit of a curve, and you have to be able to understand it well enough to do it. All right. Again, this concept of current maturities of long-term debt, recognizing that, first of all, we need to know what current liabilities are as opposed to long-term liabilities. That's something you need to make sure you understand. Secondly, that long-term debt, long-term liabilities, usually have a portion of them that are due in the next 12 months, which makes the current maturity or current portion of the long-term debt. So you'll need to understand that concept. And then payroll and payroll taxes. Again, they give you tons of information. They give you journal entries, which means you need to be able to do these journal entries and understand how they work. I don't want to spend too much time. Just clearly, anytime they give you these just means you need to understand how to do them and not just be able to do it once, but understand why and how everything works. All right. So getting into bonds. Bonds are a little confusing. So there's all this definitional stuff. Secured bonds versus unsecured bonds, convertible bonds, callable bonds. See all those blues? You should know those definitions. Again, more definitions. All right, this concept of market price and the interest rate. So there's more definitions here, and then there's a big concept here. They don't necessarily ever tell you how you calculate that market price, but they do let you know that there's this inverse relationship, right? This is a big concept, so it's one that I bet you is on the test. The idea that as interest rates go up, bond prices go down, and as bond prices go down, as interest rates go down, bond prices go up. So the nature of the inverse relationship between the two, interest rates and bond prices, is an important concept that I would make sure I understand a little bit better. And that's probably it for the bonds. Understand again how, how to write up a journal entry for a bond payable, even though it's not in here. It's simply that if you issue a bond, your cash goes up and your bond payable goes up as well. That's probably in this next chapter. Yep. So there's issuing bonds at face value. Understand those journal entries. And then there'll be the interest expense and the interest payable, the journal entry at the end of the year for the interest that's accrued, and then the paying of that interest. The discounts and the premiums, this is what I mentioned already, was the big concept for this chapter. And then how to do the journal entry if a bond is issued at a discount, and how to do the journal entry if a bond is issued at a premium. And recognizing that that discount or premium is going to be amortized over the life of the bond. Those are things you're going to see on a test about bonds. Again, the journal entry for the redemption of the bond, meaning the paying off of the bond. Typically, the bond payable goes away and the cash goes away. Easy, especially if you're doing it at maturity. If the bonds are redeemed before maturity, there's going to be some premium or some discount on the bond that's still there if it was issued at a premium or a discount. So you'll have to account for that in your journal entry. So again, understanding this concept, because it's going to ask you to do journal entries, right? You've taken these tests before, you know the kind of stuff that it continually asks you to do. And then finally, understanding how all of these liabilities are going to show up on a balance sheet. The difference between current liabilities, less than a year, and long-term liabilities, more than a year. Which information goes in the current liabilities section, which information goes in the long-term liabilities section. This concept of current maturities of long-term debt, that some of this long-term liability is going to be due this year. That's the information you need to understand so that if you're asked to either read a balance sheet and explain it, or create a balance sheet, like it might give you a series of transactions and then say, what are the balance sheet balances for each of these accounts? You need to know how to do that. So that's chapter 10. The appendix on amortization is pretty useful. In the appendix C, this accounting for long-term notes payable, where you have to make a little table, that might be something you want to review as well. This is information that was in the homework problems, so you'll probably see them again, I guess, as a point. All right, chapter 11. Starts off with a whole bunch of definitional type of information about corporations and characteristics of corporations. This gives you a big list with like a separate little write-up for each one. So you probably are going to get a question that asks you, which of the following is not a characteristic or something like that, or what's not an advantage of a corporation. You saw those on the practice tests as well. So make sure you understand that list and understand each section. Also the disadvantages. Stockholder rights, again, anytime there's these numbered lists, those make easy questions. So when it says stockholders have the right to, 1, 2, 3, 4, those are things you should know. You're going to see test questions almost guaranteed. Again, all these blue definitions, authorized stock versus issued stock, par and no par value stocks. Understanding par value, this is a thing that's probably the big issue or the big topic for this chapter that's hard for most people. Just remember that par value is an arbitrary number assigned as a value per share of stock. Usually when they write the corporate charter, that's when they assign that par value, and that when the stock is sold, it gets listed as both the par value, that's the number of shares sold times the par value, plus some amount, usually called additional paid in capital or capital paid in excess of par value, something like that, which is the amount paid for the stock over and above its par value. This is a concept that you'll probably see questions on just because it's the big takeaway. You can check out my lecture on the chapter if you want more explanation of that. Here we go, journal entries for issuing stock. Both stock sold at its par value and for stock sold at a price higher than its par value. And then what the balance sheet would look like for that, right? Those are all things that it shows and that you would expect to see in an exam. Concept of treasury stock, which is stock bought back by the company, how it impacts the balance sheet, the fact that you reduce the total stockholders' equity by the amount of treasury stock, a journal entry for purchasing treasury stock, and the fact that it's done at cost. So if you buy $32,000 worth of stock back in, then that's how it's listed on your balance sheet, and that's how the transaction's recorded. And then it shows you the balance sheet where it says less treasury stock. I would expect some sort of a, stockholders' equity section of a balance sheet with all that information, but it doesn't tell you less treasury stock. It just has the paid-in capital and the retained earnings, and then it will say what's the total stockholders' equity or something like that. And you'll have to recognize that you're supposed to subtract the treasury stock instead of add it in. And the answer with it added in will be one of the answers available in the multiple choice, and the answer with it subtracted out. So you need to understand that treasury stock reduces it. I don't know. I haven't read through the test to get you all the answers or anything like that, but I just expect that that's a concept they're going to want you to take away from the chapter. All right. The concept of preferred stock. Again, this one isn't as obvious, but you'll see a numbered list here of the advantages or the preference granted to preferred stockholders. You'll probably want to know that. Do a journal entry for the issuance of preferred stock, and this one is sold at above its par price, so you'll see that journal entry. Then it gives you the dividend preferences. It talks about cumulative dividends. Again, that's in blue. Dividends in arrears, meaning dividends from previous periods that haven't been paid yet. I would anticipate, and if you saw the self-study test, it had a number of questions where it would ask you about a stock that had so many shares of preferred stock with dividends in arrears 2 years, and they're going to pay a total dividend of X amount, and how much of it goes to the common stockholder. So it wants you to recognize that dividends from previous years on the dividends in arrears add up, and then you subtract that out to figure out how much goes to the common stockholder. Make sure you can do that because, like I said, the practice test had a bunch of questions that were like that. Additional preferences, dividends, the difference between cash dividends and how to do a journal entry for a cash dividend, the difference between the declaration date and the record date, payment date, and the journal entries that go with each one. That's going to be important. A stock dividend, where the dividend isn't paid in cash, but it's paid in stock. And the effects on the balance sheet, that's something you want to know. It was covered in the homework again, so you want to see that. And then stock splits, and the difference between a stock dividend and a stock split. Those are things that you'll need to make sure you know. So I don't know that I need to read through this whole thing with you, because really each one of these main headings, you have to understand the concepts. You have to understand the terms, which are in blue and in bold, and then understand the concept, which includes what a journal entry looks like, how it affects the other accounts, and how to do it. I guess I could just say that for all of it, but hopefully it's helpful to some of you for me to go through each of these. Retained earnings. So retained earnings is not paid in capital. This is the profits of the business. Remember, retained earnings is always the beginning retained earnings plus any net income or minus any net loss that comes from the income statement, and then minus dividends, and that will give us the ending retained earnings. Retained earnings are just the profits from previous periods that we have not taken out of the business for the owners to have. And the way we take it out of a business is through dividends. So just remember, beginning retained earnings plus net income minus dividends equals ending retained earnings. Also, look in big bold letters, retained earnings restrictions. check that term out, make sure you understand it. Always the terms. All right. Again, balance sheet presentation. They want you to understand how all of this stock looks on the balance sheet in the stockholders' equity section. So you got to know how to do that yourself. And then you should probably know how to calculate the payout ratio and the return on common stockholders' equity. And is that it? And that's it. That's the two biggies they give you this chapter. So, I don't know that I gave you much useful other than you go through the chapter, you look at the bold headings. Under each bold heading, make sure you fully understand the concept and make sure that you can create the journal entries related to that section and fully understand them. So if they're presented to you a little bit differently, you can still create those journal entries. Make sure you understand how the journal entries affect the income statement and the balance sheet. Make sure you understand the bold or blue terms in each chapter, and then make sure you can calculate, in this case, the ratios as needed. And then all those terms and lists, right? Make sure you understand the preferences that are given to preferred stockholders. Make sure you understand the rights of common stockholders. Make sure you understand the advantages of being a corporation. All of those sorts of things that are given in lists are things that are just perfect fodder for exams. I hope this is helpful to somebody. If not, if it was obvious to you, then I'm sorry I wasted your time. Anyway, have a great week and good luck on the exam, and let me know if I can give you some specific help on anything.